A very good afternoon. My name is Shaz Faruqi. This is my name. Whoever wants to reach out to me can do so. If you have LinkedIn, you can reach out to me there and by this name on LinkedIn. And if you want to get in touch get in touch with me over the phone, this is my contact number. You can WhatsApp me. Okay. And I am the co-founder of FinChartered Academy. All right. Today, what we're going to look at is we're going to do a marathon for the FM syllabus. Now, when I say marathon for the FM syllabus, I mean, of course, it's just a 2-day marathon in which tomorrow I'm not even going to do the textbook. I'm going to be doing the kit. Today, I will run you through the textbook, right? All as much as I can, I will run you through really, really fast. Okay. How many of you are writing your FM for June and you have completed your syllabus? FM syllabus is over. Others, are you able to hear me? Okay, so again, whoever is not able to hear Dell, just check. Okay, so you people are able to hear, you've completed the syllabus. Now you are here for the marathon, correct? Now, look, how I'm going to schedule this marathon is basically, obviously, just for the sake of introducing, I will touch up on maybe not the first chapter, but I will in brief tell you about the appraisal methods. Okay. And for that, I go to I'm using the Kaplan textbook. Okay. And what I'm going to do is this. I'm going to, in each chapter, I'm going to find certain topics which a lot of people sometimes get confused with or make mistakes at, and elaborate on that and keep moving to the next chapter. Okay, now again, let me start off with a slightly easy topic, which is value for money, where we talk about 3 E's. Now, let's, again, this is my habit of teaching, this is my way of teaching, where I give you some examples and analogies. So just allow me to share my screen. So you have this medicine. Okay. Tell me something. When will you say that this medicine is effective? Suppose you have a headache and you eat this medicine. When will you say this medicine is effective? Who can tell me really fast? When will you say, yes, boss, this medicine is good, it's strong, it's effective? When will you say this? When it has cured the problem. Exactly. So whenever we are dealing with, when the headache is gone, very good, Apsara. So that is what effective means. Effective means that it is helping you in achieving the objective. What is effective? You say something is effective when it has achieved the objective. When the objective has been achieved. For example, when will you say my FM class is effective? Is when the objective is in just 4 hours run you through the syllabus and ensure that you are very comfortable with the concepts and the topics. So effective is when we're able to achieve the objective. Then comes economical. What do I mean by economical? Again, the medicine that we were talking about, when will you say it is economical? Is when you got it at the best cost, at the lowest possible cost. So economical means to minimize the cost. Okay, what is economical? Economical, when economy ticket, flight ticket, economy is what? The minimum cost ticket. So economical is minimum cost. And what is efficient? Efficient basically means what? Efficient looks at how much did we put in, basically our input, versus what was the output. What do I mean by this? Is here I'm only going to put 4 hours of marathon. So my input is very less, only 4 hours. But output is what? If the output is everybody passes, all 25 students pass. Here, we are trying to say that we are efficient when with little input, we can get more out. For example, with little examples, with less class, I can explain to you everything. So efficient is when we obtain or achieve a high output with minimum input. For example, you will say if you're efficient, if you're studying only for 30 minutes, but you are completing 4 chapters in that 30 minutes, it means your input is only 30 minutes, but your output is very strong. So economy is what? Economy is minimum cost. You say something is economical when the cost is minimum. Effective is what? When the objective is achieved. When will you say my class is effective? When the objective is achieved, all the students pass. When will you say something is efficient? When with little input, you can get more outcome, output. Okay, now, although this is a very easy topic, the reason I have mentioned this briefly is because, again, yes, FM is there, but it is also there in PM. There's also a mention of this in AA. There's also a mention of this in every other paper, right? So that's why I thought I'll just quickly talk about this. Now, what I am going to look at is the investment appraisal, and we're going to look at both ROCE and payback in the next 10 minutes, believe it or not. Okay, and I'll explain ROCE to you. Again, guys, please don't expect today me doing the kit. Today, I'm only going to run you through the textbook, through the concept, through the textbook. I hate to repeat myself, but okay. Assume that in investment 1, you will get 50 rupees return. And in investment 2, you will get 60 rupees return. Where will you invest? Investment 1 or investment 2? Everybody type fast, 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 fast. Everybody have to be active. You know, Kaun Banega Crorepati, you have this fastest fingers first, correct? It is like that now. Everybody has to type fast. Everybody is saying investment 2 is better. But suppose I tell you, in investment 1, again, I'm not even writing anything. I don't like to write and bore you. All I'm telling you, all I'm going to do is draw something and explain. In investment 1, you only invest this much. You invest very little. And in investment 2, you invested so much of your money and you got 60 rupees. Now tell me which investment is better, 1 or 2? Fast, 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 fast. Yes, this fastest finger round first was won by Yash. Very good, Yash. Now you all are telling investment 1 is better. Fast, everybody. Why? Because you not only have to look at the return, you have to look at the return and compare it with what was the capital that was invested. You understand? So you will not only look at the return, you will look at the return on capital employed. What do I mean by that? You will not only look at the profit, you will look at the profit and compare it with what was the capital that was invested. For example, in this case, in example 1, in scenario 1, 50 rupees was the profit on an investment of 100 rupees. Which means you are getting a return of 50% on the investment that you made. So यहाँ पे what did we do? We looked at the return and we divided it by what was the capital that was invested. The return was 50, the capital invested was 100. So you are getting back a return of 50% on the capital that was invested. But look at scenario number 2. You got a return of 60, but the capital that was invested was 5,000. So here the return was 60 and the capital employed or invested, the capital that you put in was 5,000. So 60 divided by 5,000 as a percentage, how much is it? 60 divided by 5,000 into 100, which is 1.2% only. So you understand, you will not only look at the return and then based on that decide which project to invest, you will look at the return on the capital that was invested. When you do that, if you've understood that, you have already understood the concept of return on capital employed. What is return on capital employed? Return on capital employed says, don't just look at the returns and compare the projects. When you are comparing, like in this example, you compared between project 1 and project 2. Don't just compare the returns. You have to compare the return on the capital that was invested. And that is why return on capital employed comes in. This is a way to compare projects. This is a way to compare projects. This is a way to appraise projects. Right? You will look at the profit. You will compare the profit, but you will not just blindly compare the profit, because again, I'm writing this here. Scenario 1, profit is 50,000. Scenario 2, maybe project 1, project 2, you can call it instead of scenario 1, scenario 2. I've just completed audit and assurance marathon, so I'm still in scenarios. So this is project 1, project 2. Okay. Project 2 profit is 60,000. Now, any layman who has not studied financial management will say project 2 is better because he's just looking at the profit, which is not what you should do. You should not just look at the profit. You should look at the profit on what was invested, on the capital that was employed. For example, in project 1, we invested 1 lakh. In project 2, we invested 6 lakhs. So anybody, even you ask a 5-year-old, he will say it is better to get 50,000 from an investment of 1 lakh. Small investment, better return. Instead of getting 60,000 after putting 6 lakhs. Here, 50,000 divided by 100,000 into 100 is 50%. Versus over here, it is 60,000 divided by 600,000 into 100 is 10%. So now you will say project 1 is better because it is giving me more return on my investment, return on capital. Therefore, the ROCE is going to not only look at the profits, we will look at the profit divided by the total capital employed. It is the profit before interest and tax divided by total capital employed. So I hope ROCE is simple. Okay, let me look at just one test your understanding for each topic so that we are sure that we understood the logic and the concept of everything. Test your understanding 1. A project involves the immediate purchase of an item of plant costing 110,000. It would generate annual cash flows of 24,000 for 5 years, starting in 1 year. The plant purchase would have a scrap value of 10,000 in 5 years when the project terminates. Now, let's remove all this. I'm going to remove all of this. And what am I going to do? I'm simply going to take, okay, what was the capital that was invested? How much did I invest? I invested 110. What is my profit? There is no direct mention of profit in this question. There is no mention of profit. But we can find the. How can we find the profit? Every year you are getting a cash inflow. You are earning how much? You're earning 24,400. There's a cash inflow of 24,400. And there will also be an expense every year. Now, in this case, there is no direct mention of an expense in this question. But we are purchasing a plant. Correct? Now, whenever you purchase an equipment, whenever you purchase a device, whenever you purchase a laptop, whenever you purchase a machine, that machine, that plant loses its value over time. Why? Due to wear and tear. For example, I'm using this laptop of mine. When I bought it, it was 60,000 rupees. But today, when I went and asked the shopkeeper, he said he will give me 5,000 rupees for this laptop. Why? Because I have been using it so many years and it has lost its value over time because due to wear and tear. This loss in the value of an asset due to wear and tear is an expense for the company. What is this called? Loss of value when an asset loses its value over time due to wear and tear. What is it called? What is that depreciation? What? Okay. That is called depreciation. It just came out of my mouth. What is that expense called? That expense is called depreciation. Right? So, yes, there is a cash flow of 24,000, but there is an expense of depreciation. Depreciation is basically the loss in the value of an asset over time due to the asset being used. Right? So think about it. The asset was bought for 110%. And when you eventually gave up the asset, after the useful life of the asset has a scrap value that is, like it is a value which when you dispose of the asset, the value that the asset has, the remaining leftover value, residual value, it's all more relevant to FR. But the scrap value at the end of the life is 10,000. So you see how much has it dropped? The value of the asset has depreciated how much? From 110,000, the value has come to 10,000. So there was a depreciation of how much did the value drop by? Who can tell me? 100,000. The value dropped by 100,000 because it was originally 110,000. Then at the end of the period, there was still a leftover residual value of 10,000. So over 5 years, there was a depreciation of 100,000. This is the depreciation, 100,000 over 5 years. So the yearly depreciation will be 100,000 is the depreciation for 5 years. So the yearly depreciation will be 20,000. So this is the expense. So the expense is 20,000 per year. So the profit per year is you're getting how much? 24,400, out of which 20,000 is an expense. Therefore, profit is 4,400. Now think about it. Profit is 4,400. Capital employed is 110,000. So how much is the ROCE? Return on the capital employed looks at the profit before interest and tax, which is 4,400 divided by 110,000 into 100. So how much is the ROCE? Who can tell me? Fastest fingers first. 4%. Very good. So the ROCE is 4%. I hope everybody has understood the logic and the concept of ROCE. Mayuresh has asked a question. Why cannot we divide? That's why I wanted to do this question, because again, from my experience, even 10 days, 12 days before the exam, a lot of people have questions where these things are really out of place. What do I mean by out of place? Mayuresh, why we cannot divide the original cost by the number of years to get the depreciation is because the original cost was how much? 110,000. Correct? But think about it, Mayuresh. Out of this 110,000, not all of it is getting depreciated. When you stop using the machine, it still has a value of 10,000. तो ये जो 10,000 है, it did not get depreciated. Are you understanding? So from that 110,000, you deduct 10,000. Why? Because this 10,000 did not get depreciated because there is still a leftover or residual value of 10,000. So how much is the amount that got depreciated, Mayuresh? From 110,000, if 10,000 was the leftover value, how much will be the amount that got depreciated? The amount that got depreciated is only 100,000. This 100,000 was depreciated over 5 years. Therefore, the yearly depreciation is 20,000. It's like, Mayuresh, I will use the example of a glass. Okay, suppose this is a glass and I'm pouring water out of this glass. This is water. I pour water out, and then when I stop pouring the water out, little water is still remaining inside the glass. That water was not thrown out. Similarly, the asset has a value of 110,000, but 10,000 of that was still left over. It was still residual, like this water, which is not thrown out. So how much of the water was thrown out? How much of the water was depreciated? The remaining 100,000. That 100,000 was depreciated over 5 years. So the yearly depreciation is 20,000. You're welcome, Mayuresh. Sir, why didn't we take profits of 5 years? Because, Radhika, the reason you did not take profits of 5 years is this is the annual profit, Radhika. Okay. Why am I taking the annual profit here? Is because, look, this cash flow is the annual cash flow. So we got the annual cash flow. This is the inflow. And what is the expense? 20,000. So the profit is 4,400. That is the profit, right? Now that profit is going to be, you can say, if you do it based on the initial capital cost, you will take the annual profit. How much is the annual profit? 4,400. Profit before interest and tax. that 4,400 you will divide by the capital employed. But if you are asking me this question about why am I not multiplying it 5 with 5, can we do that? Is that a possibility? Think about it. What do you all say? 4,400 is the yearly profit. Correct? How did we get that profit also? You should know. 4,000. How did we get that profit? We got that profit like this. And then go back to ROCE. What is ROCE? ROCE is the average annual profits. It is the annual profits divided by the initial capital. Annual, yearly profit. That is why I had taken the yearly profit of 4,400. Okay, Radhika, clear? How many of you did self-study for FM? Is there anybody who did self-study? A lot of you. Okay, fine. Next, I'm going to explain to you the next appraisal technique, which is payback. What is payback? Again, guys, this is more of a marathon, so I'm going faster. In my classes, if anybody is there from my normal classes, they will know that I go in a slow pace and I get into the details of everything. But because we don't have that kind of time, marathon, what is a marathon? We're running fast. Okay, so I will now move to payback. What is payback period? Suppose you invest 5 lakhs in ACCA, suppose. Okay. Total investment was 5 lakh rupees. Now, after doing ACCA, so your investment in ACCA is how much? 5 lakhs. Now, after doing ACCA, you get a salary of, suppose, example, you get a salary of 1 lakh. So your monthly salary is how much? 1 lakh. Now the question to you is this. How much time will it take to earn back what you invested? Total investment was 5 lakhs. Monthly salary is 1 lakh. So how much time will it take? Very good, guys. It will take 5 months. This 5 months is the payback. Payback period is simply the amount of time an investment takes to return the invested amount back. Okay, now again, let me quickly go to a question on payback. Here. Okay, payback, test your understanding 4. An expenditure of 2 million is expected to generate net cash inflows of 500,000 each year for the next 7 years. What is the payback period? So investment is how much? 2 million. Yearly cash flows are how much? Yearly cash flow is 500,000. So what is the payback period? The payback, how many years is it taking me to earn back the 2 million? 4 years. So Radhika, what did you do here? Your simple formula was, payback period ka simple formula is the initial investment. All of you are telling me 4 years is the answer. How? You took 2 million and you divided it by 500,000. So the payback period formula is this formula, which is there which I am highlighting. Initial investment divided by the annual cash flow. Initial investment is 2 million. Annual cash flow is 500,000. So 2 million divided by 500,000. 4 years is the payback period. I hope this is clear to everybody. Let us move on to looking at one more question from payback where we have unequal or uneven cash flows. That is, test your understanding. 6. I have a habit of listing down all the topics that I've done in that session so that in the end we can quickly recap. Okay, you see right now at time 0, the investment is 1,900,000. So investment is how much? Investment is 1.9 million. Okay. Annual cash flow. You cannot use this formula because every year you can't use this formula. Why? Because every year the cash flow is different. So in this case, how do you calculate the payback? You will have to do it manually. What do I mean by you have to do it manually? In 1 year, you get back the cash flow is 300,000. In 2 years, you have already got 300,000 in the first year. You have collected it back. Very good, Apsara. Apsara, your answer, I believe, is right. I haven't done it, but let me just check. 300,000 is the total amount you got back after 1 year. But in 2 years' time, the total cash that you got back is how much? Already you had gotten 300,000. Plus you're getting 500,000. So you get 800,000 back. In the third year, how much are you getting? You're getting back 600,000. So the total amount that you have already received is 300,000 you got in the first year, plus 500,000 you got in the second year. So by 2 years, you had already received 800,000. So by the end of the third year, you got 800 plus 600, 1.4 million you have already collected. Now in the fourth year, you get 800,000. So the cumulative cash flow is 1.4 million you had got, plus 800,000 is 2.2 million. So by the end of 4 years, you have already collected back 2.2 million. And how much did you invest? Only 1.9 million. Meaning that your payback is after 3 years, but before the fourth year. So your payback is somewhere over here, 3 years and a few months. So your payback is 3 years and a few months. Is working capital management part revision completed? No, I've just started this revision. That part is not completed. So I'll quickly talk you through all the investment appraisal techniques, payback, NPV, IRR, all that. And then working capital also I will run to. Okay, so it is 3 years and a few months. 3 years and a few months. Now, how do I calculate how many months? Think about it this way. By the end of the third year, you had already collected 1.4 million. Amount.
And I'm told 23 3 days. But by the
end of third year. The amount received by the end of third year is how much? 1.4 million. So you have to receive only about 500,000 more in order to get your investment back. So you're seeing in the fourth year, how much time does it take you to earn 500,000? So the amount needed, still needed for payback is another 500,000. Total amount earned in the fourth year is how much? How much is the total amount we earned in the fourth year? Total amount we earned in the fourth year is 800,000. Okay. So the amount you earn monthly in the fourth year, monthly amount earned in year 4. Think about it. If the yearly amount in year 4 is 800,000, the monthly amount is 800 because there are 12 months in a year. So 800,000 divided by 12 is how much? 800,000 divided by 12 is 66,666. This is the monthly amount you earn. And what did I say? I want the amount that is still needed for payback is 500,000. So I want to know if I earn in the fourth year, every month if I'm earning 66,000, how many months it will take me to earn a total of 500,000. So number of months it will take to earn 500,000 in year 4 is 500,000 is the amount that you want to earn. And every month you're earning 66,000. So 500,000 divided by 66,000. How many months will it take? Who can tell me? 7.5 months. So the answer is what? What is the payback period? The answer is 3 years and 7.5 months, which can be rounded off to 3 years and 8 months. Asad, if you're not able to attend the whole class, the recording will be uploaded on YouTube. You can watch it at your convenience, share it with your friends. Watch it, not an issue. But I would really suggest, for the sake of interaction, you get to speak to me in this session, right? So as much as possible, attend live. So 3 years and a few months. How many months it is? 7.5 months, or rounded it off to 8 months. Now, that is the payback period, 3 years and 8 months. Some people get awfully upset. Like, for example, 3 years and 8 months can also be written as, say, 8 months. People get confused. Okay? This same answer, instead of writing in years and months, you can give the answer in years only. For example, your height. Instead of writing your height, very good, Radhika. Instead of writing your height in feet and inches, you can put your height in centimeters, correct? Similar, so you'll not get upset and say, oh, why is 5'10" here, 175 here? Either you can put your answer in years and months, or you can simply put your answer in years. That is, 8 months out of 12 months is how much part of the year? 8 out of 12 months is 0.6666 part of the year. 8 months out of 12 months is equivalent to 0.66 years. So the answer in years can be written as 3.66 years. It's the same thing. Please don't panic. Don't be like, oh, but there I saw 3 years and 8 months. Now here I'm seeing 3.66 years. It's the same thing. Okay, so this is how you do payback with uneven cash flows. So ROCE is done. Payback is done. Now we move to the next chapter where I believe we will talk about discounting. What is discounting? And again, I'm not going to take very simple questions. I'll just briefly introduce to you discounting and then directly jump to not even test your understanding 3. Maybe I'll directly jump to test your understanding 4. What is discounting? See, guys, I gave the same example in my class when I was teaching FM. Okay, my regular students, FM sessions, whoever hasn't been attending off late, I have recorded it and we've uploaded it on the NMS, which you can watch. Okay, yesterday's session also is recorded and uploaded, with which we are done. Okay, please watch it. And a few topics such as pecking order and all that, I will do today in this marathon. So don't worry about that. Anyway, let me continue. I'm going to talk about discounting and I'm using the same example which I used in my class. And what do I mean by discounting and what is discounting? Again, look. What do we have is this. I'll give you an example. Okay, in order to construct the Taj Mahal in India, you know how much it costed? Again, my regular students know. But it costed 3 crores, 3 crore rupees. Okay. It was built back in, I think, the 16th century or 15th century. I'm not sure. My history is not very good. 16th century. Okay, and I gave this exact same example. But today I will give you 3 crore rupees. I will GPay it to you. Very good, Nitesh. Nitesh is part of my class, regular class. So everything is fast. Happy. But today I will give you 3 crore rupees. Will you be able to build Taj Mahal for me today? Impossible. Why? Is because the value of money changes with time. That is, in the 16th century, 3 crores was very, very valuable. It was a very big amount. But today, 3 crores is nothing. 3 crores hardly you'll get a flat in a metro city. That also not a very big flat. So the value of money changes with time. Right? And with that, with this understanding, now that we know that the value of money changes with time, I'll give you one last example. Please bear with me. But for me, I have to make sure that examples are given. Until then, I don't feel that satisfaction. One last example is if you speak to old people, they will say, oh, my salary in the 70s or 60s, they will say my salary was 100 rupees, 500 rupees. Because in those days, 500 rupees, 100 rupees had a very different value altogether. Now, directly, let's look at test your understanding 4 of chapter 2. I got answers from 2 people already. The others, for you, I will explain net present value. Once net present value is over, I will jump to internal rate of return. All right. Now, again, think about it this way. We're investing 240,000 today. So today is time 0. Time 0 is today. Today, 240,000 is going outside my pocket. All right. But after 1 year, I will get 80,000. But the thing is this, the problem is this, I will get 80,000 after 1 year. Not now, not today. After 1 full year, I will get 80,000. I want to know the value of that 80,000 presently or today. This 80,000 I'm getting after 1 year. I want to know the value of that today, presently. right? And in order to find the present value, we will do discounting. What do I mean by discounting? I am making for this 80,000, which I'm getting after 1 year, I'm trying to find its value in today's terms. And I do that by using something known as the discount factor. How many of you know how to use discount factor and discount factor tables? Everybody? Anyway, for those who don't know, I will quickly take the discount factor table. Again, guys, we will quickly run through all the topics. So please bear with me. If a certain topic is easy for you, comfortable for you, it's okay. Just listen and then your topic will also come. Right? So I'm going to share my screen. Right? So here what happens? So what happens? Again, if you look at that is great, Varun. That's why I'm going faster, right? But again, look at the cost of capital is 9%, 9% for 1 year. If you look at 9% for 1 year, where is 9%? 9% is here. Where is 1 year? 1 year is here. So you just move your finger along and you say that the discount factor for 9% at 1 year or at 9% for 1 year, the discount factor is 0.9174. That is the discount factor. So again, think about it. The discount factor is 0.9174. So if you multiply the future value, this is the amount that you will get in the future. 80,000 is the amount that you will get in the future. I will talk about that, Varun. I will talk about delayed perpetuities, annuities, and all that. Definitely when we come to it. Just hold on. And tomorrow we will be running through the exam kit questions. So we will be looking at some very important questions. But today's idea is to run through the entire syllabus, cover the entire syllabus as much as possible, right? So 80,000 is the future value. This is the value which you will get after 1 year. The discount factor is 0.9174. So the value in today's terms for this 80,000 is, if I multiply 80,000 with the discount factor, I will get the present value. So 80,000 into 0.9174 is 73,000. Very good. 392. So this is the present value, 73,392. And again, one more important thing, guys. I am investing 240,000 today. Okay. 240,000 I'm investing today. So what is the value of that today? The value of an amount that we have today is the same. 240,000 if I invest today, what is the value of that today? Same 240,000. So the discount factor for time 0 is always 1. Similarly, using the discount factors for all the other years, what you will do, I'll go faster now. After 2 years, you're receiving 120,000. The discount factor for 2 years at 9% is this. Again, it is 8.4174. You have all these discount factors now for each of the individual years. You simply copy paste it from there. 0.77. Sorry, second year is 0.841. 0.8417. So what do? You take 124,000 into 0.8417, which is 101,004. So that is the value of this 120,000, which I'm getting after 2 years. The value of that today in today's terms is 101,004. Similarly, you do it for all the other 3 years as well. Okay, this is how you find the present values, and then finally you will take the total, which is the net present value. Okay, anybody wants me to elaborate on any specific area, or you are comfortable with the logic of this? Everybody clear? Third year also 70,000. Anybody has any doubts? Fourth year 40,000. Fifth year 20,000. However, these are all the values that you are getting in the future. So you need a discount factor, multiply it with the discount factor to get the present value. Anybody any doubts with this, or if we are clear? If we are clear, I will move ahead. If you have doubts, don't hesitate to ask. I will clarify. So I have taught you how to find the present value. So take the discount factor, whatever, for example, over here, 101,040. Okay, whatever. Okay, sorry, calculation mistake. 101,040. Take the entire discount factor. What is the discount factor for 3 years? 3 years discount factor is 9%, 0.772, or at least 0.772. If you take 70,000 into 0.772 is how much? 70,000 into 0.772 is 54,040. Similarly, like this, you do it for the other years. Quickly, everybody, let me know if there's a problem fast. If you want me to do year 4 and 5, do you, or is it all clear? If it's all clear, no need to waste other people's time. Are we clear with how would the logic of, yes, Shri, this table will be given to you? Fast, everybody say yes, no, yes, no, yes, no. Whoever is no, tell me where is the problem, I'll help you. Fast. No, that is fine. There'll be a slight difference, but that's okay. Okay, again, I hope this concept is very clear, crystal clear, and there is no problem. So everybody has said yes, meaning I will go ahead because the idea is to complete everything fast. Again, I've already taught you how to use the discount factor table. Now coming to annuity. What is an annuity? Again, annuity is not what you need. I believe that what you need is delayed annuities, delayed perpetuities, because people generally, that is where they suffer. Okay, a little about me going back. I have been teaching ACCA students from about 10 years. And delayed annuities and perpetuities is one area where a lot of people have problems. Okay, so I will simplify it. I will make it easy for you. First of all, what is an annuity? Annuity is where you get a fixed amount every year Again, Apsara, your answer would not be completely right. You've said cash flow, same cash flow for every year for a fixed number of years. That is an annuity. For example, every year, you get 50,000 for 3 years. This is an annuity. Annuity is where every year you get a fixed amount, fixed, it doesn't change. Fixed amount every year you will get for a fixed number of years. For example, you are doing a project in some, in some project you're doing. That project will last for 5 years, and every year it will pay you 1 lakh. Meaning you will get 1 lakh every year for 5 years, which means it's an annuity. So the difference between an annuity and what we saw before is, before you were not getting the same fixed amount every year. In annuity, every year the amount that you receive is the same. Okay. Now here, instead of worrying too much, in annuity you will simply take the annuity factor table. Okay, you have an annuity factor table. Please don't ask me, but the annuity factor table is given to you in the exam. For example, let us quickly look at Test Your Understanding 7. A payment of 11,400 is to be made every year for 13 years. See, from year 1 to year 13, every year the amount or the cash flow, this is the time period. The cash flow every year is the same. Every year you are getting to pay how much? 11,400. So this is an annuity because the amount is the same every year for a fixed number of years. How many years? 13 years. So in this case, you will use something known as the annuity factor, which you will get by looking at the annuity factor table. So the annuity factor is, again, over here. Annuity factor is, again, it is how much? The interest rate is 5% for 13 years. So the annuity factor is going to be 5%. The way you use the annuity factor is the same as the way you use the discount factor table. 5% for how many years? 13 years. So move your hand across like this, and therefore the annuity factor is 9.394. Okay, so the annuity factor that you will multiply this with is 9.394. Therefore, the present value or the value of this 11,400 in today's terms is 11,400 into 9.394. How much is the present value? Because remember, this cash flow is cash flow in future terms. The first payment will be made in 1 year's time, not now. So this cash flow is the future value. You will multiply the future value with the annuity factor to get the present value. So 11,400 into 9.394 is 105,000. 107,092. Let me do that again. Yeah, 107,091. So the present value is 107,091 or 92. It is 91.6 I'm getting, which you can round off to 107,092. So the present value is 107,092. Then comes perpetuities. What are perpetuities? annuity is where you get a fixed amount of every year for a fixed number of years. That is an annuity. But perpetuity is the same as an annuity. You get a fixed amount every year. In annuity also, you get a fixed amount every year. In perpetuity also, you get a fixed amount every year. But the difference is, in annuity, it is for a fixed number of years. In perpetuity, in simple English, in English language, perpetual means forever, or at least for the foreseeable future. So perpetuity is where you get a fixed amount every year for perpetuity, forever. At least for the foreseeable future. That is a perpetuity. So I hope we are clear with what a perpetuity is. Now, the one area where a lot of you have doubts, a lot of you have questions most of the time is advanced annuities, advanced perpetuities. This is what I think one of you had even asked some time back. Advanced annuities and advanced perpetuities. Annuities and perpetuities. Now, what do I mean by advanced annuity? Advanced annuity is, again, look at it this way. Advanced annuity is, suppose I tell you, every year you will get $600 for 5 years. This, anybody knows that there is a fixed amount. How much is the fixed amount? 600,000 for a fixed number of years. How many years? 5 years. So everybody knows this is an annuity, correct? But what will happen here is this. The first amount or the first transaction, the first year's amount is received earlier. What do I mean by that? See, normally speaking, this is what happens. When you talk about time period, generally and normally what will happen is, in first, after 1 year, that is in time zero, nothing, you will not get anything. You will invest. Cash flow will go out. Normally, this is what will happen. So from year 1 to year, how many years? It's a 5-year annuity, correct? So year 1 to year 5, and cash flow is $600, and you will find the annuity factor for 5 years. This is what you normally do. But in case of an advanced annuity, what is happening is the first amount of $600 is received now in time zero. The first amount is received now. So are you understanding what is happening? Out of 5 periods, 1, 2, 3, 4, 5, the first amount of 600 is received today. And therefore, because it is received today, I'm putting it as cash flow, CF, the discount factor and the present value. Because the first $600 is received in advance, that's why it's called advanced annuity. Instead of waiting for 1 year, you got the first 600 today itself. Because the first 600 you got it today itself, the discount factor of time zero, or the discount factor for today, is 1. And think about it, the value of 600 which is received today, what is the present value of that? Same 600. Now 600 was supposed to be received over a period of 5 years. Out of that, For the first year, you have already got it in the time 0. So how many years are remaining? Only 4 years are remaining now. 5 years are not remaining because already the first 600 we got it today. So in this case, what I will do is now it is a 4-year annuity because already the first amount is received in time 0. After this, you will do it as a usual question. The cash flow is 600. 4-year annuity at 10% is how much? 10%. 4-year annuity is 3.170. 3.17. 600 into 3.17 is how much? 1902. Therefore, the net present value is how much? Think about it. It is going to be this way. How much it is? 1902 plus 600. So the answer will be 1902 plus 600, which is 2502. So the answer will be 2502. You understand? Either you could do that, or what you can do, I personally prefer this approach because it's very kind of, structured and there's no confusion. But for those of you who are a little fast and they don't, they don't mind a little bit of complexity, the other way to get the same answer is you add up the annuity factor to create your own annuity factor. That is, what you can do is for this 5-year period, that is now, and for the remaining 4 years, the cash flow is 600, but the total annuity factor is 1 plus 3.17. So it is 4.17. 600 into 4.17 will get you the same answer, 2502. So I personally prefer the longer approach, but whoever understands this in and out can also go ahead with that approach. So I hope everybody is clear and comfortable with advanced annuities as well. Now, the way advanced perpetuities work is the exact same approach, literally. Right? So I will now move to delayed annuities and perpetuities. Delayed annuities and perpetuities are the exact opposite of advanced annuities and perpetuities. That is, instead of getting your money in 1 year, for the first 2 years, you don't get anything. Normally, this is how it is. Correct. Normally, how is it? Time period, cash flow, discount factor, present value. Normally, in time 0, we invest money. Discount factor normally is 1 because it's time 0. So present value is the same, 100,000. In the first year, you will get some amount. You take the discount factor for that and calculate the present value. But there are certain circumstances where in the first year, second year, you don't get anything. Maybe in the third year, you don't get anything. Maybe in the fourth year, you don't get anything. That is what is a delayed annuity and perpetuity. You understand? So what do I mean by that? Let us look at this box. What is the present value of $200 incurred each year for 4 years, but instead of starting immediately in time 1, this annuity starts in 3 years' time. The discount rate is 5%. Okay. Now, I will give you an easy way of solving this. And it is this. When you do this question, assume. Guys, all of you are here. Just say yes, 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 yes. Everybody type fast. I know this time is a little sleepy time. You know, people are a little taken aback. Not taken aback, relaxed. How do you solve a delayed annuity question? See, the problem is this. I will write down the problem and explain to you. Time period 0 right now. There's time period 1. There's time period 2. But this annuity starts in 3 years' time. So the money starts coming only from the 3rd year. 4th year. How many year annuity is it? It is a 4-year annuity. So 5th year, again you will get 200. In 6th year, again you will get 200. Okay. Now you need the value today. In today's term, you need the present value. In this case, in this question, the problem is that you cannot directly implement the annuity factor table for the simple reason. See, if it was a normal question, you could have done annuity factor 1 to 4 years, 200. You can take the annuity factor for 5% for 4 years. You can simply directly do it. But in this case, what is the problem? The problem is that the first amount that you will get is only in the 3rd year. So what we will do is, we will start with an assumption. We will assume that the 3rd year is the 1st year. Our life is half easy now. See, what was the problem? The problem was, instead of getting my first amount in the 1st year, I'm getting it in the 3rd year. So make your life easy. Just assume the 3rd year is the 1st year. And if you assume the 3rd year is the 1st year, you can simply find out the present value at time 2. That is at the 2nd year. Okay, so you see here, we are assuming there are certain steps given, but I don't want to, I thought it will be a little easy, but it is not. So I'll just explain it in my words. What I'm doing is, I am assuming that the 3rd year is my 1st year. So my pseudo year 1, pseudo year 2, I'm assuming all of this is an assumption. Okay. So in this case, do the question as usual, taking the assumption into consideration. What do I mean by that? Now you do it normally. From year 1 to year 4, it's an annuity of $200. So the annuity factor at 5% for 4 years will be 5% for 4 years. Annuity factor will be how much? 3.546. Right? So what do I do? The annuity factor is 3.546. Therefore, again, this is the time period. This is the cash flow. This is the annuity factor. Therefore, the present value will be 200 into 3.546 is how much? It is 200 into 3.546 is 709.2. So the present value in today's terms is 709.2. Everybody got this answer? GG is what, Abdul Rahim Dawar? I didn't understand. GG is what? So the present value as per this information is 709.2. So in our pseudo year 0, pseudo means pretend, imaginary. The present value of this 200, 200, 200, 200 receivable in year 3, 4, 5, 6. The present value is 709.2. Now that you've got the present value, once you get the present value, you wake up from your sleep, you wake up from your assumption, or you drop your assumption. What was the assumption? The assumption was we had assumed that the second year is year 0 and the third year is year 1. Taking that assumption into consideration, we did the question as usual and we got the present value. After getting the present value, you drop your assumption and you realize that 709.2 is the present value for the second year. We need to know the present value now in time 0. So now what you will do is, once you get the present value after the assumption, 709.2, you drop your assumption, you realize that it is the present value for time 2. Therefore, what you will do is, you will, as usual, discount the amount to find the actual present value. Are you understanding what I'm saying? See, 709.2 is the value in the second year actually. We assumed that it is time 0, but in reality, it is not time 0. So what will you do? This 709.2, you need to again discount to get the value in today's terms. How will you do that? As usual. You will as usual discount. What do I mean by you will as usual discount? 709.2 is the future value. The discount factor is how much? Think about it. This is in 2 years' time. And the interest rate or the discount factor rate is 5%. And remember, this is not an annuity now. This is a normal cash flow in 2 years. So you will use the discount factor table, not the annuity factor table. Annuity is when you are getting the same amount every year for an X number of years. This 709.2, I will discount as usual using the discount factor table. How much is it? 5%. Which year it is? Second year. So 5% second year would be 0. See this? %. Second year is 0.907. So what will you do? 709.2 is the future value. That is after 2 years. The discount factor for that is 0.907. So the actual present value in today's terms will be 709.2 into 0.907 is how much? 643.2, which can be rounded off to 643. Therefore, there you've got the present value, 643.2. So is the answer correct? Yes, my answer is correct. The The present value in time 0 is 643.2. What were the steps I took? Again, I'm summarizing this in less than 1 minute. After 5:23 p.m. Indian time, I will not continue this. Just let me summarize it one last time. Basically, in this question, what is happening? You are getting annuities, but you are getting annuities from the third year onwards. So you cannot use the normal approach. Therefore, instead, what you will do is you will make an assumption that the third year is the first year. It is an assumption. See, this is an assumption. Taking that assumption into consideration, you will do the question as usual and find the present value for the pseudo or pretend time 0. What do I mean by pseudo time 0? We are assuming that year 2 is time 0. It is not time 0. It's an assumption. We find the present value for year 2. Now that we have the present value for year 2, we will, as usual, discount it and find the present value for time 0. Are we all clear on how to discount delayed annuities, guys? Everybody comfortable? Yes or no? Quickly type. Have you all started the exam kits, guys? Exam kit completed. Very good, Deepika. Others? Little only completed. 90% finished. Very good. Okay. Now comes internal rate of return. So with that, investment appraisal more or less will be over. Shri, I will reach out to you. All these questions you can ask me, guys. Stay till the end of the session. Towards the last 20 minutes, I will keep a Q&A session where you can ask me questions. Okay, what is internal rate of return? What is this? See, guys, it's, again, now that a lot of you, most of you have completed your kits, you know that when you find the present value, a higher cost of capital will give a lower NPV. What do I mean by that? Go back to this question. Which question? This question. Go back to this question and do the same question for a higher cost of capital. Maybe increase the cost of capital to 15%. When the cost goes up, the present value will go down. The common sense logic to that is, as the cost goes up, our profits go down, correct? Using the same logic, the higher the cost of capital, the lower the net present value. And the lower the cost of capital, the NPV will go high. However, there will be that cost of capital at which NPV is 0. That cost of capital at which NPV is 0 is known as the internal rate of return. Again, I would have loved to explain this to you in more detail, but for the marathon, cost of capital, for that cost of capital, for which NPV is 0, is the internal rate of return. What do I mean by this? Okay, at 9%, we had a positive NPV. Maybe if I increase the cost of capital too much, see, at 9%, I got a positive NPV. Maybe if I increase it to 20%, my NPV will be negative. But somewhere between 9 and 20%, I will have an NPV of 0. Maybe 15%. Maybe at 15%, my NPV will be 0. Therefore, this 15% is my IRR. My IRR is the rate at which my NPV is nil, 0. Okay, I hope everybody is clear and comfortable with internal rate of return. Now, there is a formula for that. This is the formula for internal rate of return. We take two rates, just like how I've taken two rates, a lower rate and a higher rate. The lower rate will give a higher NPV. The higher rate will give a lower NPV. Substitute it into this formula and you will get your internal rate of return. I would request everybody to stay in this session, watch the entire session. I am going fast with the objective that we are able to cover everything. Okay, so we've also looked at internal rate of return. Now, what I'm going to look at is some, I think we move to the 4th chapter. Again, it is further on investment appraisal, but from what I have been seeing, I'm getting a lot of people asking me for working capital management. Okay. So let us quickly jump to working capital management. However, what I want to do is, because this is a marathon session, I will take 3 breaks in between to ensure that everybody is able to sit through. I don't want people to feel that it is too lengthy and you leave. Sit through, where we'll take a small 10-minute break and then we will continue from 5:38 onwards. And in the next session, before the next break, I will complete working capital management in full. Okay, receivables, payables, inventory, all of that I will complete in the next section. So whoever is interested in working capital management, please ensure class ending time is 8 p.m. But I will stop at 7:40. Last 20 minutes will be Q&A. Okay, so stay in the meeting. Whichever of your friends want help in working capital management, ask them to attend the next session, which starts at 5:40. Okay, thank you. Hi guys, welcome back. It's 5:40 p.m. and we're now going to be looking at the second segment of this marathon, where we're going to broadly be looking at the working capital topics, working capital questions. But generally speaking, one topic which also a lot of students have an issue with is capital rationing. I wanted to know how many of you are 100% confident with capital rationing? Capital rationing. What is capital rationing? See, again, 90%. Deepika is 90%, not 100%. Okay, Deepika, what we will do is we will get to 100% in the next few minutes, and then we will move to working capital. What is capital rationing? See, first and foremost, ideally, a business will do all the projects with a positive NPV, with a positive net present value, for the simple reason that every and any business wants to make as much money as possible. Right? We want to do all positive NPV projects. Okay, project 1 is giving me an NPV of 50,000, I'll do it. Project 2 is giving me an NPV of 80,000, I will do it. Project 3 is giving me an NPV of 5,000, I'll do that also. Project 4 is giving me an NPV of 1 lakh, I'll do that also. But the problem is all these projects will need funds, will need capital, right? However, you may not have enough capital to take up all positive NPV projects. You understand? So you may not have. So capital rationing is where the business does not have sufficient funds to take up all positive NPV project. For example, if I have to give a real life analogy, okay, you want to go to cafes, you want to go to restaurants, you like going out and eating. Restaurant 1 is also good. Restaurant 2 is also good. Restaurant 3 is great. But you want to go everywhere, but you don't have money to go to all places, even though all of them are good. Similarly, as a business, you might have 10, 500, 50,000 projects which are positive NPV. But the funds are limited. Okay, let us directly jump to a question. And I will do question number 5. We're going to look at test your understanding 5. Okay. See, look at the question. First of all, always read the question. The question is asking you to determine what? You are asked to determine which projects should be chosen to maximize the return to the business. You see project C, project D, project E, project F. All of them are positive NPV projects. Project D, okay, I agree, it is a negative NPV, so we can ignore that. But C, D, E, F, all of them are positive NPV projects. Meaning, ideally, we might want to do all of them. Ideally, we might want to do all the projects, but the challenge is this. The good projects are which? C, D, E, F. Investment required in C is 40,000. Investment required in D is 100,000. Investment required in E is 50,000. And investment required in F is another 60,000. Right, Deepika, I don't think that would be the right answer, because again, here we're talking about all the projects that you would want to do if you have 100,000. So see how much funds are needed. Funds needed are 40 plus 100 plus 50 plus 60. So actually you need 250,000 funds. But the funds available are only 100,000. How do I know this? I know this from the question. So you see, this is the problem. The problem is that, yes, there are 4 projects which are positive NPV. But what is the problem? The problem is that you don't have funds to do all of them. So based on this information, what I'm going to look at is I'm going to see which project gets me the highest NPV, C, D, E, or F. You see, ideally, it is project D that is giving me the most NPV, correct? So you will say first I will do project D. Then the second highest NPV is given to me by project E. See, the third highest is given to me by project C. And the last highest NPV project is project F. So which project should we prioritize, guys? According to this, which project should we do first? Which project should I do first? Everybody type. This is where you get mistake. See, 35,000. Yes, I agree. Project D will give me 35,000. It's like this. I'll give you a simple analogy. Section A type questions versus section B type questions. Yes, profitability index. Section A type and section B type questions are there. Section A type questions are getting you 20 marks, and section B type questions are getting you 10 marks. Which question will you prioritize, A or B? All of you will say we will prioritize A type questions. Why? Because A type questions are getting me more marks. But it's not only the return that you have to look at, you will also have to look at the investment. For example, to do one section A type question, it takes you 4 hours. So you have to spend 4 hours to get 20 marks. But to do one B type question, it only takes you 1 hour. So which is better? Spend 4 hours to get 20 marks or spend 1 hour to get 10 marks? Because in section A type questions, 20 marks you're getting in 4 hours, meaning you're only getting 5 marks per hour. But in section B type questions, 10 marks you're getting in 1 hour, meaning you get 10 marks per hour. So definitely it is better to go with section B type questions. Are you all understanding the logic? Everybody type quickly, fastest fingers first. Yes, that logic we will have to implement over here. So very good, Apsara, you're right. So you see, project C, I'm getting a return of 20,000 if I invest 40,000. So it's like the same example. It's I'm getting 20,000 marks and I have to spend 40,000 hours for that. So how much will I get for every dollar that I invest? What is the NPV I'm getting? 20,000 divided by 40. For each dollar I invest, I get a return of $0.5. What about project D? 35,000 is the return, but the investment is 100,000. So it is 0.35, meaning for every dollar that I invest in project D, I will get a return of only 0.35. What about project E? 24,000 is the return, but I'm getting 50,000. So very good. So I have to invest 50,000. So for every dollar that I invest in project E, I get a return of 0.48. And what about project F? Yes, I'm getting a return of 18,000, but my investment is 60,000. So for every dollar that I invest in project F, I get a return of 0.3. Now you have to rank this. The first rank is to C, meaning that C is getting me the highest return for my investment. Second rank is to E, third rank is to D, and last rank is for F. Based on this ranking, I will invest my funds accordingly. What do I mean by that? I will first invest 40,000 in C. Then the second rank project was project E. How much does project E need? Project E needs 50,000. So I'll invest 50,000 of my money in project E. How much money do I have left? Total funds available were 100,000, out of which 40,000 is invested in C, 50,000 is invested in E. So the funds available are only 10,000. Therefore, the third rank is to D. So I will invest 10,000 in D. So remaining to be invested in remaining funds to be invested in D. So what will be the NPV earned? Think about it. Because I'm fully investing in project C, I will get the full NPV of 20,000. Similarly, in project E, because I'm investing full 50,000, I will get the full NPV of 24,000. But in project D, I'm only putting 10% of the total funds that are needed. So NPV also, I'll get only 10%. So project D, the NPV is 35,000, but because I invested only 10%, I will get only 3,500. So the total NPV that I will get with this mix of investment is 20 plus 24, 44. 44 plus 3,500 is 47,500. I hope test your understanding 5 is easy, comfortable, and enjoyable to everybody. And there is no problem. This is what is capital rationing. All of you say yes if everybody's okay. Yes, quickly, everybody. Fast, 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 fast. So can we now finally move to working capital? Perfect. Let us now move to working capital. So I've briefed you on capital rationing as well. Investment appraisal under uncertainty. Okay, sensitivity analysis is there. Anybody has any doubts in sensitivity analysis topic? If yes, I can go back to it and do it. Don't hesitate to ask. Now I'm directly going to, oh God, these topics. So I'll finish this entire chapter in the next 5 minutes, believe it or not. Okay. In this marathon, I will complete the entire chapter in the next 5 minutes, the major numerical parts. Okay. So what am I going to do? We have something known as, see, as a business, even though we make profits, yes, Apsara, joint probability will come, but because it's a relatively easier topic, I haven't touched upon that. But if somebody wants that to be done, somebody feels there's a problem with that, we can definitely go and do it. Okay, so sensitivity. Okay, fine. Guys, just give me a couple of minutes. I will do some questions on sensitivity. Sensitivity? Okay, Trisha wants sensitivity and Apsara wants joint probabilities. First of all, what is sensitivity analysis? When it comes to sensitive, yeah, Apsara, I know. Trisha has asked for sensitivity. So I'll quickly talk through that and come to joint probability. What is sensitivity analysis? Sensitivity analysis sees, for example, I'll give you an analogy to explain this. But the analogy is this. It goes like this, right? How do I put it? Suppose I want to know how much sugar affects the taste of our cake. Suppose we made a cake and I want to know how much sugar affects the taste of our cake. So what will I do? It's very simple. It's very basic. What I do is I will bake the cake 2 times. I repeat, I will bake the cake twice. One time, everything else will be same. All other variables will be the same. The amount of chocolate will be the same. The name of the chocolate will be the same. The amount of cream will be the same. The amount of all this will be the same. But the first time you will put sugar. Second time, what will happen? Again, compared to the first time, all the variables will be the same, but you will not put sugar. So why are we doing this? We are doing this to see how sensitive is the taste of the cake to sugar. We are doing this to assess how sensitive is the taste of the cake to the sugar. What do I mean by this? How much does the taste of the cake change if just sugar changes? If just the quantity of sugar changes? You understand? All other variables will remain the same. We want to see
It's 6
what
o'clock.
will happen to the overall performance if just one variable changes. So we keep everything else the same and we just change one single variable in that. All right. So that is what sensitivity is. And I will explain sensitivity further to you with the help of test your understanding too. Test your understanding too. Now, as per test your understanding too, Batcher Co. is considering investing 500,000 in equipment to produce new type of ball. Sales of the product are expected to continue for 3 years, at the end of which the equipment will have a scrap value of 80,000. Sales revenue of 600, blah, blah, blah. All this information is there. Find the percentage changes required in the following estimates for the investment decision to change. So basically, they're asking you to calculate how sensitive are we. And Trisha wants to look at scrap value. How do we do this? The way to do this is this. See, first of all, as usual, let's find the net present values. But because of the shortage of time and because we've already looked at net present values, I'm directly going to the answer and showing you the net present value. You can just copy paste that. Because part A of the question talks about the NPV calculation for this question. So at the end of the period, first of all, what is scrap value, Trisha? Scrap value is at the end of the period, the leftover value, the residual value which you will get when you sell the asset at the end of the period. That is what is scrap value. And the NPV is 33,000. Just have a look at this NPV calculation. So now what we are looking at is, we're seeing how sensitive is this business to the scrap value. That is, what I mean by this is, as of now, the net present value is 33,000. How much percent, how sensitive are we to scrap value? As in, how much scrap value can we allow? How much change in scrap value can we allow before the NPV turns zero because of scrap value? For example, right now, the scrap value's present value is how much? Is 53,000. Correct? This means that the scrap value must fall by how much? How much is the NPV? 33,000. For the NPV to become zero, NPV zero is a very big problem for us. We don't want NPV to become zero. For the NPV to become zero, the scrap value should fall by 33,000. This, we are putting it as a percentage, Trisha. What do I mean by we are putting this as a percentage? What I mean is this scrap value, how much scrap value on a rainy day, maybe it's a rainy day, nobody comes and buys the machine from us at the end of 3 years. How much change can we allow in the scrap value before it starts bothering us? How sensitive are we? We can allow the scrap value to fall not more than 33,000. Therefore, 33,000 is how much it can fall out of a total scrap value of 53,000. 33,000 divided by 53,000, how much is it, Trisha? It is, I'm getting 62.26%. So if the scrap value, so the sensitivity is 33,000 out of 53,000 into 100 is 62%. So that is how much is the sensitivity. That is how much. Got it, Trisha? Yes, sir, got it. Okay. Clear, Trisha? So basically what I'm trying to say is, we can allow up to 62%. Scrap value can fall down max by 62%. If it falls more than that, the NPV will become zero. Meaning the cake will now start tasting bad for us. But if you see, we are very sensitive to initial investment. There is a sensitivity of only 6.6%. Look at selling price, 2.4% sensitivity, meaning that if the selling price falls even by 2.4%, we will start having problems. We are very sensitive to selling price. One of your juniors will come and ask, ma'am, can I give a discount to this customer? You will say, no way. She will ask you, ma'am, can I give a 5% discount? You will say, are you out of your mind? Because even if there's a 2.4% drop in the selling price, NPV will become 0. So we are very sensitive to selling price. Are you understanding? We are very, very sensitive to selling price because the sensitivity is only 2.4%, meaning even a 2.4% change will affect us. So Trisha, is this clear? 200%? Now we look at joint probabilities. I will explain joint probabilities with the help of an analogy. Listen very carefully, everyone. But what do I mean by joint probabilities is this. Suppose the chance of your friend wearing black color to office is 50%. The probability of your friend wearing black color to the office is 50%. Okay? It's 50%. But what is the chance or what is the probability of your friend wearing black and you also wearing black? Let me ask this question again. Point number one, the chance of your friend wearing black, friend one, friend A, first friend is friend A. The chance or probability of friend A wearing black is 50%. And the chance or the probability of friend B wearing black color is to office is 50%. Now, the question is, what is the chance or probability of both friend A and friend B wearing black? What is the probability of both friends wearing black? Okay, let me see what answers you give. What is the probability of both friends wearing black? The probability of friend A wearing black is 50%. The probability of friend B wearing black is 50%. What is the probability of both wearing black together? Some great people, in spite of taking tuitions, in spite of taking classes, they tell me the probability of both friends wearing black together is 50 plus 50, 100. Please remember the chance of both of them wearing black, it is a coincidence. So the chance will be lower. So the probability of both friends wearing black is 50% is the probability of friend A wearing black. 50% is the probability of friend B wearing black. So the chance of both of them wearing black is 50 into 50, 0.25. That is 0.5 into 0.5 is 0.25. In 200, the chance is only 25%. It's like a coincidence. So obviously the chance will drop. Apsara, is this clear? Okay, do you want me to do test your understanding 5 or you just wanted like the logic of it? Because I don't mind doing it. Just let me know if this is clear or do you want me to also help you with test your understanding 5? Okay, we will do test your understanding 5, all right? So look at test your understanding 5. See, a company has estimated the cash flows for a project, incorporating the probability of each present cash flow into its estimates. So year one, the present cash flow is 100,000, and the probability of that is 20%. There is also 200,000, and the probability of that is 80%. Okay. First of all, wait. Yeah. Let us look at the joint probabilities. Year one could be 100,000, 200,000. So there are 2 years. Okay. Now, in year one outcome or one cash flow that we can get is 100,000. Okay. But the probability of getting 100,000 is only 20%. And in year two, one outcome or one cash flow is 200,000. And the probability of that is 30%. So what is the probability of us getting 100,000 in year one and 200,000 in year two? The total value, what is the probability of us getting 300,000? What I will do, Apsara, is the amount that I will get is 300,000, but the probability of this happening is very less. It's a coincidence. Why? Because this is a joint probability. Not only should you get 100,000 in the first year, you should also get 200,000 in the second year. Already the probability of getting 100,000 in the first year is only 20%. And the probability of getting 200,000 in the second year is only 30%. So the joint probability will be further lower. You understand? 0.2 into 0.3. How much is it? It is 0.06, which is 6%. Which is 6%. Meaning the probability that both will happen is very less. So it's 300,000 into the probability of the first outcome into the probability of the second outcome. So 300,000 you will take into 6%. So what will you get? 300,000 into 6. The present value into the joint probability is how much? 18,000. 300,000 into 6% is 18,000. Apsara, for you to understand this even better, I'll give you an example. Okay? Suppose you wrote an exam and came. The exam result was bad. The exam result was bad. Now, what is the probability that your father will be in a good mood? Only 50%. What is the probability that your mother will be in a good mood? Only 20%. What is the probability that both of them will be in a good mood? It will be 50.5 into 0.2, which is 10% only. Apsara, is this clear? %. So this is how you find joint probabilities. Now, keeping that in mind, you can look at all the other outcomes. The other outcome is 100,000 in year one, 300,000 in year two. The other outcome is 200,000 in year one, 200,000 in year two. And then the other outcome is 200,000 in year one, 300,000 in year two. Now that again, because I'm not doing all the calculations, I'll take you to the answer because you can see all the calculations worked out there. You see, this is what I had got. 0.2 into 0.3 is only 6%. 6 into 300,000 is 18,000. Similarly, you got all the other values. So sum of the present values was 450,000. Investment was 400,000. So expected net present value is 50,000. Now, the only scenario that gives a negative NPV is if the cash flow in year one is 100,000 and year two it is 200,000. See here, what do we get? That is the only scenario where you are getting a negative NPV. Okay. Apart from that, all the other NPVs, you see row 1 on the table here. The joint probability of that, this is found by multiplying together the individual probabilities, which is 0.06. Okay, so what does this question ask? Look at test your understanding 6. Test your understanding 5. The probability of the investment having a negative NPV, the only place it is negative, where is it negative? The only place it is negative is over here. Therefore, the probability of the investment being negative is only this 6%. What about E? The question is asking the probability of the investment having an NPV of 0. That is there in 2 scenarios. Second row and third row. 2 of the scenarios in the table give an NPV of 0. Therefore, the probability of 0 NPV is found by calculating the probability of scenario in second row with the scenario in the third row. The probability of the second row is 14%. The probability of the third year is 24%. So what do? The probability of the second row happening is 0.14. And the probability of the third row happening is 0.24. Therefore, if you take both into consideration, as the 2 results are mutually exclusive, what do I mean by mutually exclusive, Apsara, is either this can happen or this can happen. Both cannot happen together. So the probability of 0 NPV happening is, one probability for that is 14%. Other probability for that is 24%. So the total probability of us getting an NPV of 0 is 24% plus 14%, which is 38%. So there's a 38% probability that the NPV is 0. Okay. Apsara, is this clear? Everybody clear with this? Quickly type fast. We have Abdul Rahim, we have Bhavya, we have Del, we have Hassan, we have Jay, we have Kenny, we have Mayuresh, we have Nitika, Nitesh, Pavan, Radhika, Trisha, Yash. Everybody quickly type. Perfect. Let us now finally move to working capital management. Now, in this session, what I'm going to do is I'm going to, believe it or not, complete this chapter in the next 10 minutes. Okay, this chapter is talking about what? It's talking about liquidity, it's talking about liquidity ratios and all that, right? See, first and foremost, what is liquidity? Liquidity is basically our ability to pay our current liabilities. Liquidity, we have current liabilities, right? Like we have our bills payable, we have our the suppliers who are payable, right? We have current liabilities. We have our electricity bill that needs to be paid. All of these are current liabilities. Now, Abdul Rahim, do you want to break now? So all of these are current liabilities, okay? Now, do we need the ability to pay our bills? Okay, just give me 2 minutes. Do we need the ability that as a company, we need to have the ability to pay our current liabilities? We need to have the ability to pay our bills. This ability to pay our current liabilities is liquidity. Liquidity is basically our ability to pay our current liabilities. What is liquidity? Liquidity is our ability to pay our current liabilities. With that, again, we can go ahead, take this small break, 5 minutes. We'll continue from 6:31. Back. We're looking at what? We're looking at liquidity ratios. As I said, what is liquidity? Liquidity is the company's ability to pay our current liabilities. Okay. Now, tell me one thing. Will you pay your current liabilities with your non-current assets, or will you pay it with your current assets? For example, if you want to pay your EB bill, will you pay it with your property, or will you pay it with cash? Will you sell your property to pay your electricity bill, or will you pay your bill, will you pay your current liability with current assets? You will pay it with current assets. That is why liquidity formulas has two ingredients. It has current assets. So in order to pay your current liabilities, you need current assets. That is why liquidity formulas are current assets divided by current liabilities. Okay. This formula is known as the current ratio. Current ratio is current assets divided by current liabilities. The answer has to be more than 1. This means the answer, when will it be more than 1? Simple maths, when the assets are more than the liabilities. And ideally, in order to be able to pay all your liabilities, your assets have to be more than your liabilities. Then comes quick ratio. What is quick ratio? It is the same as current ratio. What is current ratio? Current ratio is current assets divided by current liabilities. Quick ratio is also the same thing. But in quick ratio, tell me one thing. If you want to pay your liability quickly, pay your electricity bill fast, quick. Okay, within current assets, if you have cash, yes, you can pay your liabilities quickly, because cash you can easily pay fast. If you have receivable is also a current asset. If you have receivable also, you can call up that receivable, tell them to pay you, and you can pay your liability. But what about inventory? People who are walking on the road, can you kidnap them and force them to buy your products? Can you force them to buy your inventory? Can you force them to buy your services? No. So inventory takes time. First, somebody has to come and buy it from us. After they buy it from us, they will take a few days to pay. Only after they pay, I can use that to pay my bill. So because inventory takes time to be converted to cash, inventory takes time to pay current liabilities. Out of the current assets, inventory takes the most amount of time to pay the current liabilities. Because inventory takes time to pay the current liabilities, if we want to see if we can pay the current liabilities quickly, from this formula, current assets by current liabilities, from the current assets, we will subtract inventory. So the quick ratio is current assets minus inventory divided by current liabilities. Everybody okay with this? Quickly, yes, 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 yes. No, no, no. Tell me whatever it is. Go fast, run fast. Perfect. Moving on to receivables days, payables days. We have something known as, what is that? Receivables days, inventory days, receivables days, payables days. All of this I will cover, with which majority of this chapter will be done. What is receivables days? It is the number of days you take to collect your receivables from your customers. As simple as that. So receivables days is equal to receivables divided by, when will you have receivables? When will you receive money? When you sell or when you buy? When will you receive money? When you sell something or when you buy something? Yes, that is why the formula is receivables divided by sales on credit into, remember, whenever you're calculating days, whenever you calculate percentage, you will multiply with 100. But whenever you are calculating days, it will be receivables divided by sales on credit into 365, because you're calculating days, and that is the receivables days formula. Similarly and oppositely, payables days formula is what? Payables. When will you have payables? When you buy or when you sell? When you purchase. Very good. So the formula is payables divided by purchases on credit into 360. As simple as that. Payables days is the number of days you take to pay your dues to your supplier. As simple as that. Then comes inventory days. See, when you buy the stock, as soon as you buy the stock, will customers come and take it from you? No. You will keep it in your shop, you will keep it in your warehouse. Inventory days sees how many days does the inventory stay in the warehouse before it's sold. Therefore, inventory days is inventory divided by, when do you get inventory? You get inventory when you produce or when you buy. Therefore, inventory divided by cost of sales into 360, with which this chapter is. Now you simply have to substitute these things in these formulas to get the answers. Okay, so receivables days, payables days, liquidity, current ratio, quick ratio, receivables days, payables days, inventory days, all of this is done. Okay, can we move to the next chapter, guys? Where we will be talking about some very important things such as inventory control. And I'll do a few examples. Trisha wants overcapitalization and over trading. See, when you're dealing with working capital, what happens is this. Okay, when you deal with working capital over here, overcapitalization, over trading. See, when it comes to business, Trisha, I'm explaining this for you. Listen very carefully. Business needs capital. That is, business needs funds to run. Correct? For example, guys, excuse me. Am I audible to everyone? Yes. Business needs capital. Business needs funds to run. Now, when we speak about funds, when we speak about capital, right? See, we need money to run the day-to-day operations of the business. We need money for working capital, basically, for day-to-day running of the business. And we need money also to invest in projects. Now, the question is to you. If I give you capital, where will you put that capital in? In one, which is in working capital, or will you put money in projects? Where will you put the funds? Where will you put the funds? In the working capital or invest? So Trisha, you say you will invest the funds. That is, you will not put working capital. You will put all your money in projects. But Trisha, what you are not realizing is we need money to run the business on a day-to-day basis. Yes, we need to invest in projects. Projects will help us earn profits, but we also need money for day-to-day running of the business. We also need cash. We also need working capital. Because Trisha, if all your money is gone in projects and there is no funds to run the day-to-day operations of the business, how will you pay your bills? You ask with sir, why me? Not quite sure who is asking you what, Deepika, but whoever wants to ask me anything, you can ask me. Right? So as I was saying, we were talking about what? We were talking about working capital, right? You need money to run the day-to-day operations of the business. Otherwise, yes, you will put money in projects. Projects will be profitable, but who will pay your supplier? Who will pay your bills? So Trisha, a good amount of your funds needs to also be invested in working capital. So a little bit of it is invested in working capital, and a little bit of this is invested in projects. But what FM syllabus is trying to teach you is how much you put in projects is important. Because Trisha, if you put too much of your funds in working capital, look at this. Here, out of $6, majority of the dollars is being put in working capital. Working capital as in cash, in inventory. It's like you have a lot of cash in your hand. I said we need cash in hand. I said we need cash in hand. But if we have too much working capital, that is a problem. Why? Because unnecessarily I have unused cash. I will have unused cash. I will have unused inventory, too much inventory. Instead of this, I could have invested it in projects. Correct, Trisha? Do you agree with me? Instead of putting all this money in working capital, I could have invested it in projects. So, yes, you must put a part of your funds in working capital. But when you put in too much of funds in working capital, that problem is known as overcapitalization. Trisha, are you clear? It means you have too much cash, too much receivables, too much inventory, which is not required. Instead, you could have invested that in projects. When that problem arises, that problem is known as overcapitalization. Over trading is the opposite of overcapitalization. This is where you have invested a lot of funds in projects. Majority of your funds are invested in projects, because of which your business is growing fast. But yes, business is growing fast, but unfortunately, for the business to be running smoothly, what will happen? You need funds. And if the business is growing, you will need more capital. But when that does not happen, you don't have enough working capital and just the business is growing and growing, that will lead to a problem where the business is growing, but you don't have enough capital to run the business. That problem, Trisha, is known as over trading. Is this clear? Over capitalization and over trading. Is this confirmed? Perfect. Moving on, we move to the next working capital topic. Where we are talking about the economic order quantity. What do I mean by the economic order quantity? What is the economic order quantity? See, when I order supplies, there are two things involved. Two things are involved. What are the two things involved? One, see, either I can order in bulk and all of this bulk, I need to store it in a place. But the advantage of ordering in bulk is what? I don't have to order again and again. So I don't need to pay delivery fees again and again. But the downside of it is what? The downside of it is I will need a big warehouse to keep all this stock. So what will I do? Okay, I don't want a big warehouse. So instead of ordering in bulk, what I can do is I can order one piece every time. So because I'm buying one, I don't need a big warehouse. I can keep it in my bag. I save on hand holding cost. Basically, I save on warehouse cost. I save on all those costs. I save money on holding costs, meaning I don't have to spend money on holding the asset because I only have one piece of inventory at a time. But what will happen? Because I order one by one every time, I will have to order again and again. Because I have to order again and again, I have to pay a high delivery cost. So economic order quantity tries to solve this problem by telling you what is the best quantity that you should place the order for such that the cost is minimal. Are you all understanding what is economic order quantity? And the formula again, guys, see in the normal classes, I literally go line by line. The ones who've done FM with me, any paper with me know this. But because this is a marathon, now I've directly come to the formula. The formula is what? The formula is EOQ is equal to EOQ, economic order quantity is root 2 COD by CH. Before EOQ, which topic have I covered? I have covered receivables days, payables days, inventory days, liquidity ratios. Oh, and I also covered overcapitalization and over trading. I'm also doing things based on demand. I mean, as much as I'm trying to cover fast and go through things based on whatever I feel is more important and relevant, I am trying to do everybody's topics. So anybody having any questions anywhere can ask me. Tomorrow risk might be risk, exchange rate risk, interest rate risk. Yes, sure, I can cover those topics. And tomorrow, because I think we're already running short of time, tomorrow I can make like the first half, all these topics, risk, exchange rate risk, interest rate risk. I can talk about the, capital structure, in capital structure, yeah, WACC, all that I can talk about tomorrow. Okay, don't worry. So in the business valuation also, yes. So basically today I've done more or less, today by the end of the day, I'll cover the first half. Tomorrow I'll cover the second half, and then I will do the kit questions. So the formula is root 2 COD by CH, where CO is the ordering cost, D is the annual demand, CH is the holding cost. I will try, Hassan, depending on the time, depending on the availability, I will try to do as much as possible. Okay, so test your understanding 1. Let us look at this is test your understanding 1 from chapter 8. Okay, a company requires 1000 units of material per month, meaning the yearly demand is, if it is 1000 per month, the yearly demand is 12,000. The cost per order is $30 regardless of the size of the order. So CO is $30. Whether you order one piece or whether you order 10,000 pieces at once, the ordering cost, almost like the delivery cost, is $30. The holding cost, CH, is 2.88 per unit per year. Now you have to substitute this into the formula, wherein EOQ is equal to root 2 into CO, CO is 30, into D. What is D? 12,000 divided by 2.88. The root of that, if you can take, that will be the EOQ. Who can give me the answer of this? $1.6970 is not possible. The answer is 500. It means every time we will order 500 units. Deepika, you want to recalculate? Which is the cheapest option? The cheapest option is to go with 500 pieces every single time. Okay. Yes, calculation error. Similarly, you can do test your understanding too. Now, either you can use EOQ, which is easier and faster, or for each quantity, you can find out how much will be the total cost one by one. And that way also you can calculate. But the faster approach is to use the EOQ. Right? So one other way is one by one. Okay, for 400, how much would the cost be? For ordering 500 each time, how much would the cost be? For ordering 600 units each time, how much would the cost be? Either you can do it that way, or and find out which is the cheapest, or you can directly use EOQ formula. All right. So that is looked at. Now, guys, let's look at are you all comfortable with EOQ with discounts? Anybody want support? Okay, Deepika, you want test your understanding 5. I'll do test your understanding 5. Okay. So guys, see, remember this is a marathon where I'm running you through some topics based on your demand, based on where you need support. So test your understanding 5. What is reorder level? See, suppose there is an old lady. She eats medicines. Now, if she eats medicines and you have to order medicines for her, it will take 2 weeks for new medicines to come. My question is, will you place new order after all existing medicines are over? Will you place the order after all existing medicines are over? Definitely not. You will reorder when there are still few more medicines left. Reorder level is that quantity at which, that level at which you place the order again, that level of inventory at which you will place a new order. That is the reorder level. Okay, so now that you've understood the concept of reorder level, let us look at test your understanding 5. Okay, using the data for WCO, assume, okay, so WCO meaning we have to use some other question. Okay, test your understanding 3's information we have to use. Assume that the company adopts the EOQ as its order quantity. Okay, so the company has adopted EOQ as its order quantity. And that it takes 2 weeks for an order to be delivered. How frequently will the order need to be placed, and how much inventory will it have on hand when the order is placed? So this is a very interesting question. There are 2 questions. And who asked me this question? Deepika. Deepika, the second part of the question is asking you about the reorder level. Okay, the second part. Right? So how do we do this? What do we do in this case? What we do is, see, in this example in W, the yearly demand is 30,000. And as per that question, I don't know what is the EOQ, but I'm just directly going to the answer and referring what the answer was. 3162. 3162 barrels. So, Deepika, to answer your question, test your understanding. Right? Annual demand is 30,000 and EOQ every time you will order 3162 units. How did I know this? This answer we got in test your understanding 4. Right? So what will I do here? It's very simple. See, the yearly demand is 3162. Correct? Annual demand is 3162.
It's 7 o'clock.
Sorry, I'm not. I apologize. Annual demand is not 3162. Annual demand is 30,000. Okay, just give me 1 second, guys. Yes. So what we will do is every time you will order 3162 and the total number of orders, or rather the total quantity you need is 30,000. So 3162 is how much you will order every time, and the total quantity you need is 30,000. And as I said, similar to receivables days, payables days, whenever you calculate the number of days, whenever you calculate the frequency, you have to multiply with 365. Therefore, 3162 divided by 30,000 into 365 is how much, Deepika? It is 38 days, meaning that you will place the order every 38 days. Now, how much inventory will be in hand when the order is placed? That is the reorder level. See, it takes us 2 weeks for the new order to come. You understand? It takes us 2 weeks for the new order to come, and in a year, how many weeks do we have? 52. So the reorder level will be this. It will be 2 weeks it takes. Again, let me try to simplify this. Just give me a minute. Yeah, let me simplify it this way. I need 30,000 every year. So every week I need how much? 30,000 divided by 52. So the weekly demand is how much? Weekly demand that I have is 30,000 divided by 52 is 576.9. This is my weekly demand. And what did I say? 576.9. It takes 2 weeks for the new order to be delivered. And the weekly demand is 576.9. If the weekly demand is 576.9, and you know for 2 weeks, it will take 2 weeks. So you need enough material, enough inventory for 2 weeks. Inventory needed for 2 weeks will be 576.9 into 2, which is how much? not 115. How is it possible? 115. 576. It will be 1000 something. 1153.8. This means you know that for 2 weeks you need 1153.8 pieces. Therefore, and you know that it will take 2 weeks for the new order to come. So you need to have at least 1153.8 pieces when you place the order, because it will take 2 weeks for the new order to come. So you need to have stock for 2 weeks. Deepika, is this question clear? 200% clear? Perfect. So we've also looked at Test Your Understanding 5 from chapter 8. Guys, in this specific chapter, if there is some area where you need specific help, let me know. In receivables and payables. But I intend to now cover you through which chapters? Now look, one more thing, one important key thing is, if you have understood, even when I did my normal class, this is the order in which I did, okay? After completing chapter 8, I directly went to chapter 10, for the simple reason that chapter 8 topics are very similar to the logic of chapter 10. What do I mean by that? If you've understood the EOQ model, if the EOQ model you've understood, then the Baumol cash management model is also very clear, because it is very similar to EOQ model. In fact, the formula is literally the same and the logic is literally the same. So the reason I've come to this quickly is to make you realize that once you have mastered EOQ, Baumol model becomes easy because it's more or less the same thing. Okay. Now we're looking at the Miller-Orr model. What do I mean by Miller-Orr cash model? What I mean here is that cash levels keep going up and down, correct? But once it crosses a certain limit, there has to be a maximum level. Okay, it's a good day, everybody is paying me cash, cash is going up, 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 up. But once it reaches a certain point, I need to take out that cash. I can invest it. So what I will do, I will allow cash to go up to a certain maximum level. Once it has reached that maximum level, I will remove the cash from the wallet and I will invest it and I will bring it back to a return point. Now, there could also be situations where cash is going down, 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 but I don't want the cash to go too down. So once it reaches a certain minimum point, what I will do is I will realize that it has touched the minimum point. So I will now inject more funds so that the cash balance is back to the return point. It is like filling petrol in your car. That is the best analogy I can give you for this. Okay, what do I mean by this is, you won't wait till the entire petrol is over, correct? Once it reaches a certain minimum level, you will go and fill up the petrol. Once it reaches a minimum level, you will refill. Similarly, once it goes to a maximum, you will not say, oh, okay, let it be there. I will not drive this car. Once it reaches the maximum, you will start driving the car and bring it down back to some minimum point. Right? So Miller or model works in the same way. Right? And that is what it is. And again, there are certain formulae that are given in the examination. Trisha, I hope that answers your question. There are certain formulae that are given in the examination. For example, the return point is lower limit plus 1/3 of the spread. And what is the spread? The spread, again, there's a formula which is given to you in the exam. It is 3 into 3/4 into transaction cost into variance of cash flows divided by interest rate raised to 1/3. Again, you will understand that better when we do test your understanding 3 from Miller or model chapter 10. Okay, so what do we do here? Let us look. Okay, guys, I'm just going to fetch myself some water. I'm just moving away from the screen for a minute. Yes, guys, let's move ahead with Test Your Understanding 3 in the 10th chapter. Again, look at the question. They first want you to calculate the spread. Okay, how do you calculate the spread? There is a formula to calculate the spread. Go back to the top. What is the formula? This is the formula to obtain the 3 into 3 by 4 into the transaction cost. You just substitute the information given to you in the formula. That's all. So you have to make your life easy and simple. So spread is equal to 3 into 3 by 4. I hope this is being recorded. Yes. 3 into 3 by 4 into what? Transaction cost. And as per the question, what does the question say? What is the transaction cost? The minimum cash balance is 20,000 is required at Miller or Co. and transferring money to or from the bank costs 50. So the per transaction. So the transaction cost is 50. Into what? Variance of cash flows. Now, how will you get the variance of cash flows? Go down. Variance of cash flows is 9 million into 9 million. How do I know this? From the question, and hence the variance is 9 million divided by interest rate. How much is the interest rate? Interest rate is 0.03%, meaning 0.03 divided by 100. So 0.03% is 0.0003 raised to 1 by 3. Now I'm not able to do it here. Raised to 1 by 3. Three into 3 by 4 into 50 into 9 million divided by 0.03. Okay, so if you do this, you will get your answer. Just do this on the calculator and you will get your spread. Now, because of the shortage of time, I'm just going to the answer and referring what the answer is, but this is how you get the answer. Okay, Deepika has got the answer. It's 31,201. Now that we've got the spread, using the spread, you can get the other things. Return point is there. Upper limit, lower limit. So return point you can easily get now that you know the spread. However, one thing I want to tell you is the minimum cash balance is 20,000. And the spread is 31,201. I repeat, the minimum cash balance is 20K. Okay. Return point is lower limit plus 1/3 of spread. Return point is how much? Where is the return point? Return point is here. Lower limit. How much is the lower limit in this question? The lower limit, the minimum balance that we need is 20K. So the lower limit is 20,000 plus, what do you have? One-third of spread. 1/3 of spread is how much? Spread is 31,201. So 1/3 of that, 31,201 divided by 3. So how much will it be? 20,000 plus 31,201 divided by 3. How much is it? How much is the return point? Who can tell me? 30,400. I'm just going by what you people are telling me. Okay, I'm not checking the calculations. So we have the return point. We know the lower limit and we know the spread, and now we can easily calculate the upper limit. How can you calculate the upper limit? Think about it. Return point is 30,400, correct? Is that so? Is this right? 30,400 is the return point. So I hope there is no problem. Spread is 31,201. Return point is 30,400. So what will the upper limit be? There is a spread of 31,200. Correct? Meaning, what is spread? Spread is basically between the lower limit till the upper limit. How wide are we spread? So spread is 31,200 and the lower limit is 20,000. So the upper limit will be 20,000 plus 31,200. So see, lower limit is 20K. Spread is how wide is the distance between the lower and upper limit, and the spread is 31,201. So the upper limit will be 20,000 plus 31,201, which is 51,201. I hope you all are okay with this. That is the Miller or model. Everybody, let me know. So guys, we've completed all these topics. And out of all the people that are here, I don't think anybody was regularly part of the FM batch. So I want to ask you now your feedback. I hope you can share with me privately, personally, or even generally. You can share with me your thoughts, your feedback, your experience, your any suggestions, anything of that sort. You can share with me. Feedback, thought, experience. So if you're asking me which chapters to study, well, look, you have to make sure that, I mean, I cannot tell you like this chapter, this topic as such. But try your best in the time that you have, that you're able to master section C questions. Okay, so we will do at least one or two tomorrow in the, in the marathon tomorrow, because it's a 2-day marathon, because obviously in one day already 4 hours, it's still quite a lot. 4 hours of time is a big amount of time. So we've split it over 2 days. So tomorrow also we will have the marathon. So in that tomorrow's session, I will be doing exam kit questions as well, along with a few topics like, you know, capital structure, certain important topics from the later chapters. Whoever wants to reach out to me can always reach out to me on this number. Whoever wants to connect with me on LinkedIn can connect with me by searching this name. Yes, Abdurrahim, I have typed it. How you can contact with me in personal. Either you can WhatsApp me on this number, and to stay in long-term touch, you can connect with me on this LinkedIn profile. So whoever has sent me connection requests, I've already accepted them. Can you please take one extra session for theory revision? Yes, I can try that, but not tomorrow. Tomorrow I will be walking you through, not walking, running you through the other topics of FM and exam kit section C and all that. Then after that, for 2 days, I have PM marathon. So whoever, if anybody is also doing PM, you can also attend that marathon. After that, basically Tuesday is another marathon with you. Wednesday, Thursday, I have PM. So probably we can consider scheduling a marathon again on for FM on Friday. That is what is possible. Where I can run you through like theory questions and all that. Okay. So how is it, guys? 4 hours. Do you think it is too much of running, or is it fine? It is fine. Okay, it is too much worthy. Okay, that is good. Okay, now let me see if I've missed anything which any of you asked. Factoring arrangement. Trisha has asked. Is Trisha still here? Trisha is not here. Okay. Anyway, we've now looked at Miller or model as well. Now, what I am going to look at is, in brief, okay, I can also look at what it is and all that. Eldon Co. is a medium-sized company producing a range of engineering products. Okay. Blah, blah, blah. All of this is there, but you have to read the question. Determine the relative cost and benefit of using the factor in each of the following cases. See, first and foremost, what you need to know, Trisha, is when it comes to what is factoring. Factoring is what, who can tell me what factoring is? Factoring is where somebody else will come and collect your receivables on your behalf. See, you have receivables. This is why I asked if 4 hours is too long, because I already see when we started, we had like 30. Now we have 6. And the person who asked this question is also not there. Probably tomorrow I will see if you are there, and then based on that, this question when you are here. Okay. Now, what do we have? There is a major theory chapter on economics. How many of you have some questions or problems in economics? How many of you want me to look at economics? Anybody has a requirement for economics to be done? Yes? Okay. Economics. So first of all, we're looking at macroeconomics. What is macroeconomics? Macroeconomics is the big level economics that affects the countries, that affects that is basically the economics, the branch of economics that looks at the bigger level economics, where we look at the overall behavior of the economy. For example, Microeconomics might be looking at me and my ability to buy something. Individuals, basically, it looks at the economic situation of individuals. But individuals or individual businesses. But macroeconomics looks at what? This looks at the bigger picture. Is the management of economy by the government, right? And now we have this. We have something known as potential for conflict. What do I mean by potential for conflict? Some of the objectives of the government for the sake of the economy are conflicting. What do I mean by conflicting? I mean, from my point of view at least, I want many businesses. FinChartered is only one business that I have, but I want many businesses. Correct? But at the same time, along with wanting many businesses, I want a lot of free time to do whatever I like, to go out, to travel, to go to restaurants, to roam in malls, to meet friends. You see, both of these are objectives that I have, but both these objectives are conflicting with each other. What do I mean by both these objectives are conflicting with each other? Having a lot of businesses means you are going to be very busy. You will not have time for roaming, traveling. It is very difficult. For example, look at this marathon itself. I've had this marathon from 4 to 8. And then before that, in the morning, also, I was having classes nonstop. How will I roam? And on top of that, if I have other businesses, how will I have free time? Similarly, government also has certain objectives with respect to the economy. For example, the government's one objective is full employment. The government wants to make sure that everybody who is looking for a job gets a job. But at the same time, what do we have? Another objective the government wants is price stability. And the two will be conflicting, because if everybody gets a job, for example, Abdur Rahim gets a job, Apsara gets a job, Bhavya gets a job, Deepika gets a job, Del gets a job, Nikita gets a job, everybody has a job, meaning everybody will have money. If everybody has money, everybody will demand more things. If demand for things goes up, price for things will go up. So how will there be price stability? So you see, two or more objectives, when they conflict with each other, that is conflict between the objectives. There is a potential for conflict. Right? That is what this is. Moving ahead further, we're talking about monetary policy. Monetary policy, as the name suggests, it's amount of money in circulation is controlled. The amount of money that is there, the supply of money will affect the economy. Because think about it, if there is more money, meaning more demand. More demand means increased prices. Increased prices means basically that is inflation. Right? So the government, what happens is the government uses certain monetary policies. What is monetary policies? This is basically controlling the supply of monetary. Monetary means what? Money. Monetary policy is concerned with influencing the overall monetary conditions in the economy. Either you directly control the volume of money in circulation, which is controlling the supply of money, or indirectly controlling the money supply through altering the price of money, that is interest rates. One way we can control how much money is available in the market is by directly controlling the volume of money in circulation. Either that we can do, or we can increase it. Because remember, whenever you want to borrow money, But when you borrow, you have to pay interest. That is the cost of the debt. Cost of the debt. I'm sure you've studied this in your, which chapter is that? It is in cost of capital. That is the cost of the debt, interest. But what people can do, what the government can do is increase the interest rates. When interest rates go up, the cost of debt goes up, meaning that they have to pay back more money to borrow money. So people will stop themselves from borrowing and automatically the money supply is controlled. This is monetary policy. Again, I would have loved to stay on that for some more time. But again, given that we are rushing, I will move ahead. Then comes what is fiscal policy? Fiscal policy is the government's actions. What do I mean by government's actions that controls the economy? See, government can easily and to a great extent control the economy. Not a lot of people agree to this. There are a few people who say government should do nothing. We will look at that also. But what is the fiscal policy? Fiscal policy says that government can control the economy by their activities. For example, when the government spends, what will the government spend on? Government will spend on roads, government will spend on airports, government will spend on infrastructure overall, government will spend on education, government will spend on healthcare. When the government spends on all this, automatically there are more ongoing projects. Okay, there are more ongoing projects. So if Deepika wants a job, there are so many projects she can work in. In the country, there are so many projects going. Meaning job opportunities increase. Business opportunities increase. This will reduce unemployment. Then the government also controls the economy by taxation. When the government feels that the prices of things are going up, there is an inflation, government might increase taxes. Why will the government increase taxes? So that more of our money goes back to the government and so that the demand for things will go down and therefore prices will be controlled. Are you all understanding what I'm saying? Yes or no? Everyone? Now, I will end by talking about corporate governance. What is corporate governance? Corporate governance, tell me one thing, just close your eyes, close your books now. Okay, what is corporate governance? If I run a company, should I be in a position to hire whoever I want? Or do you think there should be some rules to hire people? Should I be able to hire? Yes, Deepika, there should be some rules. Next question. Should I be in a position to set my own salary? I want 15 lakhs per month. Can I set that? My own salary? No. Should we have rules for this? Yes, definitely there should be some rules. So what is corporate governance? Corporate governance is nothing but a set of policies, set of rules by which a company or a corporate, that's why the name is corporate governance, a set of policies, a set of rules by which a company is run, administered, managed, or controlled. All of this is also known as governed. Running, administering, managing, controlling. This is known as governing. So the set of policies, rules, systems by which a company corporate is governed is known as corporate governance. That's all. So with which chapter 11 on economics has been briefly summarized. Now let me stop sharing my screen. What I have is this. Okay, majorly in these 4 hours, I have completed about 11 chapters, as much as I could. All the important things, all the areas where you had questions and doubts I've covered, which is about half. Tomorrow, the remaining half I will cover. If required on Friday, we can catch up again, where we will sit and do what? We can sit and do exam kit questions, we can sit and do theory questions, all that I can do. This will be upon demand. I cannot promise. If there is demand for it, we will take a poll in the group. We will put a poll. If the poll says, through the poll, if we have a good number of students who are interested in the third marathon or the third episode of the marathon, we can by all means have that session. But if not many people are looking forward for that third session, then you can definitely individually reach out to me on these platforms, either on WhatsApp or LinkedIn. You can reach out to me with whatever questions you have, and I will be happy to individually support you. So we will put a poll after tomorrow's marathon. We will ask feedback. We will ask you if it was helpful. We will ask you if, you need a third marathon. And if yes, then we will by all means go ahead and do that. In this group, the marathon group, we will share the feedback form. Okay, so you can by all means go ahead, and if you feel that you want a third session of the marathon on Friday, you can put your feedback, how your experience was. Did you like the class? If you like the class, also let us know why did you like the class, because that will encourage others also to attend, because this is a free marathon, right? So it's not something that will cost money to anybody. So if you like the marathon, take a moment in the feedback form. Let us know why did you like it? What is it that you found helpful? What is it that you found useful? What is it that you did not get before but you got now? Because we will use that to inform others also, encourage others also to join. In that form, after you have put your experience, your feedback, your thoughts, you have shared how this marathon has helped you, you can also say that we are looking forward for the third session of the marathon. So based on the demand, we will come back and we will. So as we were talking about demand, right? When demand goes up in economics. So it's all based on that. So based on demand, we will have the third marathon, which again, I will not promise now, but depending on feedback, depending on all that, we will discuss internally and we will announce it. Tomorrow, we will cover these topics and we will close. Okay, anybody who is outside India? The 5 people who are present. Okay, Abdurrahim is from Pakistan. Avya, Deepika, Del is from where? Okay, great. So guys, we will share. Also, this marathon also will be uploaded on YouTube. So any of your friends, because remember, this is free service. So share it with your friends, whoever is attending their ACCA exam, share it, whatever it is, use these services. Okay. So once we upload it on YouTube, we will inform in the group. And now in some time, we will share the feedback form, fill it up, let us know. All right. I will stop this session now. tomorrow we will continue from 12 to 20 and close. Okay. Thank you so much, guys. Bye.